We welcome you all here today. I'm Scott Anderson, President and CEO of Zions Bank, and I'm excited for today's presentation as we hear about the current conditions in our country and in our state and in our region from an economic point of view. We present these events to keep our clients and our communities up to date about what's happening in the economy and in the market trends. But I'd like to give you, before I introduce our program, a brief overview from my view of what we've seen last year and what I think we'll see briefly in 2024. And hopefully, this will get you thinking about the presentation that Robert will be giving and questions that you can ask him. But after the roller coaster ride of the past 3 years, our overheated U.S. economy transitioned back toward pre-pandemic norms in 2023. And last year, as you all know, the Federal Reserve raised interest rates and tightened monetary policy. Many people thought that the U.S. economy would be driven into a recession, but that didn't happen, and our economy remained resilient. And in the last part of last year, the Fed held interest rates steady for the third consecutive time. And with inflation easing, the Fed said that they had penciled into this year, 2024, three borrowing rate decreases, and that the first cut could come as early as the second quarter of this year. And why would they do this? I believe that they looked at inflation and they saw that it had dropped dramatically from mid-2022, and where it fell from a 40-year high of more than 9% in June of 2022 to about 3% in November of 2023. But with food and energy prices coming down, getting to the Fed's target of a 2% annual inflation rate could take some time. We're not there yet. And that's because the services price inflation is still sticky, despite the fact that prices of goods and services are down. Additionally, the expected lower mortgage rates that we hope to see later this year could spur home price increases again, and that could have another impact on inflation. Likewise, workers sidelined during the pandemic didn't return to work fast enough to meet the demand created by the strong job growth during the recovery, as many have in this room experienced. However, the labor market, while still strong, began softening in 2023 as job growth slowed and historically low unemployment rates ticked up slightly. As I look ahead, I believe that unemployment could continue to trend higher in 2024 as job growth slows to long-term averages that we've seen in the past, and more workers rejoin the labor force, improving the labor shortage. Higher interest rates and housing inflation colored consumer opinions about the economy in 2023. But recent consumer surveys have found that people are feeling more optimistic about 2024. And this is important as consumer sentiments can drive behaviors like spending and investments, often acting as a self-fulfilling prophecy. This year, I also believe that international conflicts will continue to create uncertainty. Spillover effects from the Israeli-Hamas war, which should continue through this year, the Russian-Ukraine conflict, which also will continue through this year, and growing tensions between China and Taiwan could impact the U.S. economy, adding to domestic uncertainties surrounding the presidential election year. However, as we head into 2024, our Utah economy remains strong and resilient. We continue to benefit from strong population growth and net in-migration, low unemployment, and solid job growth. I'm confident that what we'll see here in Utah will be a strong economy this year and that will continue to thrive, even though other parts of the world and other parts of the U.S. economy may suffer a bit. But let's see if Robert Spendlove agrees with this. And like I said, hopefully these comments will start you thinking about questions to ask Robert. But it's now my pleasure to introduce to you Robert Bruff, Rob Bruff, the Director of Marketing and Communications from Zions Bank, and he's going to be the MC for today's program. So, Rob.
Thanks, Scott, and thank all of you for being here with us, those who are here in the room and those who are joining us virtually. We appreciate that you would take the time to be here with us. I'm personally looking forward to this presentation from Robert Spendlove. We're here to hear from him and his outlook and his insights on our economy. Robert is the senior economist here at Zions Bank, where he monitors and he reports on economic indicators and public policy developments. Robert is well known both locally and nationally for his insightful and understandable approach to explaining economics. At the end of Robert's formal presentation, there were a number of questions that have been submitted by you and others who are joining us virtually, and I will moderate a Q&A session with Robert as we'll address with him some of those questions that you have asked of him in advance. And so with that, it's my pleasure to introduce Robert Spendlove, Senior Economist at Zions Bank.
Well, thank you so much for coming. I really appreciate it. We've been doing these annual economic outlook events for a couple years, and we really enjoyed the opportunity to reach out to our clients and our customers and the community to kind of give a wrap up of the last year, and also talking a little bit about what we're seeing for the next year. And so thank you so much for coming today and for your attention. So what I want to do just really quickly, let's see if I can get this to go again. Hey, can we try? Maybe Jared, you might have to advance that. Okay, so just a quick wrap up of what we saw, some of the trends that we saw in 2023. 23, you know, we're what 3 years since the 4 years since the pandemic started, and we saw historic distortions in the economy because of the COVID pandemic. And not only because of the pandemic, but also the reaction of the economy, the reaction of individuals, reaction of governments to the pandemic. And what it did was it just distorted the economy in a historic way. And so a lot of what we're seeing now, a lot of what we've seen in the last few years is because of these historic distortions. Jerome Powell, the head of the Federal Reserve Bank, over the summer, he addressed this and he said, right now, trying to forecast the economy is trying to navigate, like navigating by the stars in cloudy skies. So, you know, it's just, there is this great deal of uncertainty right now in the economy. And we saw a lot of that in 23. There was the expectation that as the Fed dramatically raised interest rates, that it would cause the economy to slow, that it would cause the economy to contract, that we would see a drop in gross domestic product, a drop in employment demand. We saw a little bit of that, but the economy ended up being very resilient and very strong. We saw inflation has been coming down, employment has been improving, but people are still grumpy. That is one of the things that I hear all the time is people say, well, you know, yes, things may be a little bit better, but they're not the way they should be, and they're not the way they were before. So I want to kind of talk through a little bit of those trends and what we're seeing and why we're seeing that. So let's start off with the Fed. The Federal Reserve, in response to the pandemic, dropped rates. And let me just point out a few things. When you think about historic distortions, we've seen a number of distortions. And the first distortion that we see in the economy happened before the pandemic. So look at this period from about 2009 to 2021, where the Fed had interest rates effectively at zero. So what we're looking at here is the federal funds rate. It's the overnight rate that the Fed really manages. It influences the rest of interest rates. But following the Great Recession, by the way, the shaded areas are recessions. The big one right around right around 2008, 2009 is what we call the Great Recession. It was the biggest recession since the Great Depression. That's when the housing market collapsed. And so the Fed responded by pushing that Fed funds rate all the way down to zero. And then they kept it at zero effectively for a generation. What did that do? That spoiled all of you. That got all of us expecting that rates would stay low forever. It changed individual decisions. It changed business decisions. It changed how we viewed the economy. We said, okay, great. We're going to have low interest rates forever, and we're going to operate as if interest rates will be low forever. So they retrained all of us. And then you have the big pivot. You have the pivot in 2022 where the Fed reverses that, and they go from zero on their Fed funds rate to over 5% in about 18 months. So that's the Fed going from slamming on the gas to slamming on the brakes. And what the Fed is trying to do is they're trying to slow down the overheating economy that happened during the pandemic. And so again, in normal times, what you would see that push us into a recession. So that's why economists were overwhelmingly expecting that we would go into a recession in 2023. So that's what the Fed has done. But you can just see these dramatic changes in how the Fed is operating and how the market is operating. So then the next question is, how does this compare to what they've done in the past? So we're looking at how the Fed has increased interest rates in different economic environments. The most recent one that we're in right now is that dark blue one for 22. So you can see they raised rates higher and faster than pretty much every other period of rate increases for the past several decades. So that just shows us the intensity of the Fed effort of how dramatically they're changing the economic environment. So then what is the Fed going to do? So this is, I was speaking to someone a few minutes ago, and he said, well, I heard you speak in November. How is this different? And I said, well, the nice thing is my presentation changes every day because the economic environment changes every day, but it really changed since November. And this is the reason. This is what has driven markets since mid-December. So the Federal Reserve meets every 6 weeks, and every other meeting they produce a new forecast of where they think it will be appropriate to have the federal funds rate in the future. And this is what it looks like. We call this the dot plot. So each one of those dots represents a vote of one of the Federal Reserve governors. And it's saying, where do you think it will be appropriate to have interest rates in the future? And it's really, this is a relatively new product of the Fed. They used to not tell us. They wouldn't tell us what the rate was now, and they wouldn't tell us what's going to be in the future. You just had to figure it out. And now they publish it, and so we see it. And so what the big change of this is the Fed had been messaging before December. They'd been saying, yes, we've raised rates over 5%, and we're going to keep going. The message was the rates will be higher for longer. And then the Fed met in December, and they changed that message. And that's what this is showing. So it's saying just a few things to point out. On the upper left, we call that the terminal rate. That's the rate where the Fed stops increasing rates and then decreases them after that. So they changed that terminal rate to be 5.4%. So we're essentially there right now. And so they're saying we're done raising rates. And then the other big one is that forecast for 2024. So they're saying by the end of this year, they expect to be able to drop that Fed funds rate down to around 4.6%. So that would be the equivalent of 3/4 point rate decreases by the end of this year. The other important one is on the right. We call that the neutral rate. this is another one of those rates that is not possible to directly measure. It's the rate that the Fed thinks neither accelerates or decelerates the economy. So they're saying if the Fed funds rate is at 2.5%, we're essentially just coasting. So we're still in a restrictive policy environment where they're trying to slow the economy, but they're saying we'll get closer to that rate sooner than we thought. And so this is really what changed the markets. The Fed's saying we're going to stop increasing rates. We're going to hold them steady now, and then we anticipate that we'll start dropping them into 2024. So this is what the Fed says they're going to do. Look at what the markets say the Fed is going to do. And by the way, there we go. The markets have generally been better at saying what the Fed's going to do than the Fed has been at saying what the Fed's going to do. So the Fed says 4.6% by the end of this year. Markets are predicting 3.8%. So the markets think that the Fed is going to be even more aggressive in their rate decreases than what the Fed says. If the markets are correct, then we'll see a much better economic environment, a much lending. The lending environment will be easier than it is now, and it will spur more economic growth. Now, this one is interesting. The Fed forecast only changes every 3 months. This number changes every day, and so this is what the markets are thinking right now. But this could change, and it has been changing as the as new economic data is coming in. In fact, we're getting new. Like I said, my presentation changes every day. Friday, we get a new jobs report, so that'll be really closely watched by markets. And then next week, we have a new reading of inflation that will be a big market mover as well. But so you have the Fed and you have markets both saying we're heading into a lower rate environment in 2024. The other thing that the Fed has been doing that no one ever talks about, this is one of those huge impacts that no one knows about. So we always focus on the Fed interest rates, but the Fed also has this balance sheet. So the Fed goes on this on the secondary market, in the bond market, and they buy and sell bonds. And so this is the way that the Fed can really, it's a new tool that the Fed has only really used since 2008. In fact, you can kind of see the Fed going in. So before 2008, the Fed's balance sheet was about $800 billion. The Great Recession was so bad and the economy was struggling so much that the Fed goes in. You can see those. We call them quantitative easing. There's the first round, there's the second round, and there's the third round of the Fed quantitative easing. Essentially what they're doing is they're just buying up bonds, trillions of dollars of bonds. Specifically, they're buying Treasury securities and mortgage-backed securities. So this was the Fed essentially injecting another tool into their tool bag of how they influence the market. The Fed's balance sheet went from $800 billion to over $4 trillion in the 20-teens. And then as the economy started to improve, the Fed starts to let off on that balance sheet. They tapered that, they started reducing that size. And then the pandemic hits and they completely reverse that again. And they go from $4 trillion in their balance sheet to $9 trillion. So they doubled the size of that balance sheet in about a 2-year period. Again, it's the Fed throwing everything they have at the markets and trying to force the economy to grow. Now, the big story over the last year, though, is the Fed has now reversed that. So they increased rates, and then at the same time, they started allowing that balance sheet to reduce by about $100 billion a month. So they're reducing that balance sheet by $100 billion a month, and they'll continue to reduce that balance sheet throughout 2024. Again, they don't actually sell, but it has the same effect of selling, but they're reducing mortgage-backed securities and Treasury securities. One interesting thing, if you see that do you see the little blip in the orange at the top? That is the failure of Silicon Valley Bank. And that had the possibility of creating what we call contagion in the financial industry, where one bank failing causes other banks to fail. So the Fed actually re-injected liquidity into the financial markets by expanding their balance sheet during that period. But they've since, as the financial situation has improved, the Fed has backed off that again. So kind of taking that, what does this do to markets? So and I'll try to move through these quick because they're a little bit complicated. But the blue line is the 10-year bond. The red line is that Fed funds rate. And you can see how the Fed dropped that Fed funds rate after the Great Recession down to zero. The 10-year bond followed the Fed down and got down to the low rates that we saw during the, that's after the pandemic recession of 2020. They dropped that Fed funds rate back down to zero. The 10-year followed that down. And then as the economy started to overheat, the Fed started aggressively increasing that Fed funds rate. But look at the 10-year bond. So this kind of gives you an insight into the markets. Every time that 10-year bond peaks and starts going down, it's the market saying the Fed's done. It's the market predicting that the Fed has reached that terminal rate and now they're going to start cutting rates. But they guessed wrong several times over the last few years. They guessed wrong in late 2022. They guessed wrong in in early 22, in mid 22. Again, they guessed wrong. Right there again is the in March of 23 is the failure of Silicon Valley Bank. And then, so the big question now is, have they guessed right? So the market, the 10-year bond really started to increase in the fall of 23, actually surpassed 5%, very briefly got above 5% because the market thought the Fed would keep going. There was, and I'll show you some of these, some of the factors that were driving that increase in the 10-year bond, but then has quickly reversed. And just in the last 2 months has come back down to now the 10-year bond is down back below 4% again. So the thought on Wall Street and markets is that because the Fed has messaged that, because we're seeing economic conditions better than we were expecting, that the Fed will be able to drop those rates down. Okay, now I'm making it really complicated. But what we're looking at, the red is that 10-year bond. The green is the Fed funds rate, and the blue is the Fed's balance sheet. So you can see, so if you think of it, the blue and the green are the Fed's tools, and the red is the market's response. And so you can see how the Fed had that traditional tool of interest rates in green, and then they threw in that new tool of the balance sheet in they really started to use it in 2009, and it's the Fed just exerting all their control over the markets to kind of force it to take action. It's going to be really interesting to watch over the next year, over 2024, to see how the markets react. One of the big questions is because the Fed hasn't used the balance sheet tool before, because they hadn't used it before the Great Recession, we don't entirely understand exactly what the impact of it is. We know what the markets do when the balance sheet goes up, but we're not sure what happens when the balance sheet dramatically goes down. And we will be watching that. I'll be watching that really closely over the next year as the Fed, I expect the Fed will reduce that balance sheet by another $1 trillion. And by the way, so what does it mean when the Fed increases their balance sheet? It's the Fed printing money, right? So the Fed printed $5 trillion of new money. That's what that expansion is. So what is the Fed doing right now? By reducing their balance sheet, they're burning money. They're taking that money they shoved in your pockets and they're pulling it back out of your pockets. And so we don't exactly know how the markets will respond to a dramatic reduction in the balance sheet, but we'll be watching that really closely. So one of the big impacts, the reason we care so much about the 10-year bond is 30-year mortgages are based not directly, but very closely on that 10-year bond. The difference is generally about 2 to 3%. So 30-year mortgages are about 2 to 3% above the 10-year bond. So you can see it almost looks the same as that 10-year bond. But we saw those mortgage rates kind of drifting down over that generation of very low interest rates. And then the Fed reverses that. You know, all those people, all of you all that got your mortgages at 3%, the Fed reversed that, dramatically increased or had the impact of dramatically increasing mortgage rates over the last year and a half, and essentially locked in everyone that got a 3% mortgage. So and what we've seen is that the real estate market, the mortgage market, essentially just stalled. It just stopped moving. We stopped seeing building in the same numbers that we had seen previous to that period, and people just stopped moving. And so, so we saw that freeze out just in the last few weeks. So that 30-year mortgage rate topped about 8%. It's been coming down ever since the Fed made that announcement. This morning, it's at 6.6%. That should be enough to start the market going again. Anecdotally, I'm hearing that somewhere around 6.5%, in that range of 6 to 7%, could start inducing people back into the housing market again. And that's something I'm watching really closely. So then what I'm doing here, the blue line is back to that, and I wanted to go back to that 10-year bond because that's the one that really matters. So this is looking at a sensitivity to housing prices in our market. So Zions Bank covers Utah and Idaho, looking at the sensitivity of housing prices to those interest rates. And what you see is those housing prices in our market have been very sensitive to those rate changes. And this is looking at the month-to-month change. So 1 month change in housing prices. You see that after the pandemic, the Fed pushes down those rates, and look how the housing market just takes off. We see these dramatic increase in home prices because of those ultra low rates. The other dynamic that drove that was a change in the nature of how people live. So we saw a dramatic movement of people out of the coasts, out of cities, and into more suburban, rural areas, and in parts around the country. So we see that there was that push of higher interest rates, or excuse me, the push of lower interest rates, coupled with that pandemic distortion of people changing their housing demand, which drove those prices up. It starts to settle down a little bit. And then this one was really interesting, right? The market started to reheat again right around the beginning of 2022. We saw that in early 22. The Fed starts driving up those rates, and look how it pushes that market down. That very sensitive market, we saw it pushing down housing prices across Utah and Idaho, reversing a lot of those increases, not completely reversing them. Housing prices are still a lot higher than they were pre-pandemic, but we saw a reversal of that. Just in the last few months, we saw those housing prices starting to recover, starting to adjust back up again. But historically speaking, we've never seen that kind of dramatic fluctuations in our housing prices, and a lot of that was driven by those rate increases. So the big question now, and this is what I'm watching really closely, on the right-hand side, we've seen those housing prices kind of stabilize, kind of level off at lower increases, but with those rates coming back down, we have the potential of seeing that housing market start to reheat again. So this is the tough part. This is the balancing act, the tightrope that the Fed is walking. They don't want the housing market to collapse, but they also know that a big reason that we saw high inflation over the last couple of years is because of overheating housing markets. And so how do you find that right level that keeps the housing market moving, but prevents it from overheating? And that's another thing that I'll be watching really closely in 2024. Let's see. Another one of those issues that became a problem in the fall and then all of a sudden went away is national debt. You know, it's really interesting. People always ask me, when are we going to care about the national debt? And I say, well, eventually we will, but we don't yet, which is just weird. For about 3 weeks, we cared. In the fall, if you think about those 10-year bond rates going up to 5%, a big part of that was concern about the national debt. The bond market started sending the message, we're not happy with the level of national debt. So what we're looking at here is federal debt as a percent of gross domestic product. So it's saying, what's our debt relative to our total economy? The dotted line is where we are right now. So what we're seeing is our national debt is the highest relative to the GDP that it's ever been in a non-war period. What's the projection? It's going up. And so by itself, this has spooked markets, but what they're really focused on is this slide. And this is the cost of servicing that national debt. So if you just think about your household budget, the more money that you have to spend on servicing your credit card, the less money you have for other things that you want to do. And so the cost of servicing that debt is the red line. And this is according to the Congressional Budget Office. So this is kind of the official source. We see that within a few years, the cost of servicing that debt starts to surpass other budget priorities. It starts off with non-defense discretionary, then it goes to defense spending, then it surpasses non-defense discretionary spending, then it surpasses Medicare, and eventually surpasses Social Security. Now, this doesn't mean that the country collapses. This doesn't mean that we turn into a Greece debt crisis. But what it does cause to happen is we don't have the ability to spend on our priorities, our public policy priorities, to the extent that we could in the past. And so a potential outcome could be something like Japan, where we just see, a decade or more of substandard growth. And it just prevents us from being able to grow to the potential that we'd like. And then meanwhile, we have the prospect of other countries getting stronger, like China, like the BRICS countries that have been kind of banding together with an alternative to the U.S. form of markets. So that's something that, again, the bond market cared about this for about 3 weeks, then they stopped caring. But this is one of those themes that I think will be coming back in 2024. Congress put together a stopgap measure to cover the annual budget, but that stopgap ends in a few weeks. Congress is going to be coming back. They're going to be debating they call it a continuing resolution. This continuing resolution of how they're going to be spending money. The debt limit will come up again. The debt ceiling will come up again, and it's going to be one of the big items of discussion over the next several months. So with all this, like I said, the expectation is that the economy would slow dramatically in 2023 or even contract. So our most popular measure of a recession is GDP. Specifically, a recession is defined as 2 consecutive quarters of negative GDP. So here's one of the problems. We had that. We had that in 2022, and it was not a recession. So one of the things we know is that our data is sending the wrong message. So what we know is that GDP specifically did not accurately portray a recession in 2022. But let's look at 23. In the third quarter of 2023, GDP surprised to the upside, grew 4.9%. I don't think that is accurately reflecting what's happening in the economy. I don't think any of you think that the economy dramatically accelerated in the third quarter, but it's some of those distortions from the pandemic that we have to be really careful about. However, it's very clear that we didn't contract. In the third quarter, we didn't contract in 2023, and this is a sign that the economy is much more resilient than we had expected in 2023. A big reason for that, and so I included in here are components of gross domestic product. So if you think about it, it's essentially consumption or consumer spending plus business spending plus government spending plus net exports. But the most important part of the economy is that dark blue. It's consumer spending. It's all of you going out and doing your Christmas shopping. It's all of you heading out there. It's about 2/3 of the economy is consumer spending. So if consumers, well, it actually, I was going to say if consumers feel good and that the economy is doing well, it doesn't matter if you feel good because you're all grumpy, but you're still spending. And so that has been another one of the big surprises is even with consumers being grumpy, you all went out and bought your, Black Friday gifts, and you all went out and got holiday presents for everyone, and it kept the economy going. But you still are grouchy. So looking at consumer confidence, you can see that our consumer, and this is the Conference Board. There's another major measure of consumer confidence from the University of Michigan. It shows similar trends, which is consumers were very confident, felt really good going into the pandemic, coming in at around 130. We see that dramatic shock of the drop in consumer confidence in 2020, started to recover into 21, but then we kind of got hit with inflation. You can really see that impact of inflation on consumer confidence. Drove it down. Consumers are feeling a little better than they were about a year ago, but still at lower levels than we saw before the pandemic. Our other big measures. So if you kind of think about how do you actually define a recession? How do you define an economic expansion? How do you define these different characteristics? In my opinion, the single best indicator of the economy is the unemployment rate. And you can really see that where in recessions, one of the defining characteristics of a recession is the unemployment rate goes up dramatically. We generally consider it when it goes up about 0.5% to 1% would be that defining characteristic. And one of the things about unemployment is once it starts to move up, it moves up very quickly. You can see that in 2008, 2009. You really see that dramatically in 2020, where the unemployment rate went from 3% to 15% in 2 months. That is an indicator of the economy collapsing. But what happened is that unemployment rate drops down, and it's essentially been right around 3.7, 3.5, 3.9% for the past year. So that unemployment rate, people are not losing their jobs in large numbers. We're not seeing mass layoffs that we had anticipated could have happened in 23. In fact, I would argue that our unemployment rate is still defined as an economy with labor shortages. We really want to be in that pink zone between about 4.5% and 5%, where everyone who wants to find a job can find one, but employers can also find the employees they need. So we're continue to be defined by very low unemployment. I'll tell you on Friday, when the new jobs data comes out, this is the number I'm going to be watching the most, is that unemployment rate. When we look at labor force participation, this has been looking pretty good. Again, you see that dramatic shock. This is the percent of people in the population that are working or looking for a job. We see that dramatic shock as 22 million people lost their jobs overnight. It's been coming back for the past few years, but we're still not back to where we were pre-pandemic. We still have a greater share of the population that is not working today than was working before the pandemic. If you want to look at specifically who that group is, the group in red is what we call prime age labor force, so people 25 to 54 years old. The blue one is people 55 and older. So what really happened is those older workers that were displaced during the pandemic never came back in. And by the way, that gap, that difference between now and pre-pandemic is about 3 million people. So we've got 3 million people that would have been working if it weren't for the pandemic that are not working. So the big debate has been, well, everyone always says, well, when do we return back to normal? I'll tell you, that looks like a new normal to me. That looks like we are, this is looking like it's a trend. And so then you have to say, okay, it's a new normal and we need to learn to adjust to the new normal rather than expecting it to go back to the way it was before. When we look at wages, so now let's kind of transition into our inflation a little bit. So the goal that we want to see with inflation is 2% annual inflation, and then we want to have about 3% wage inflation. So that gives you real wage growth or wages over inflation of about 1%. One of the big problems that we've had over the last year is this wage inflation has been too high. It has been dropping, but it's still around 4%. And that is driving, and you're going to see this in just a minute with especially with service sector inflation, that wage growth is driving overall inflation higher. Because if you just put yourself in the perspective of an employer, it's great for employees if you're getting big pay increases, but employers have to come up with that money somehow. And as their margins get squeezed, they're forced to raise their prices to pay those higher wages. And the fear is that this could turn into what we call a wage price spiral, where higher wages drive higher prices, which again drive higher wages. That's what we saw in the 1970s that drove inflation even higher. But when we look at inflation, again, we saw the beginning of that inflation in about March of 2021. And we're looking at the US is in green and our region is in blue. We saw that inflation surging up to the summer of 22 when it topped out around 9% nationally and over 10% in our region. The inflation is coming down. It's been coming down a lot, but we are entering what I would call a sticky period of inflation. If you look at that over the last 6 months, that inflation is starting to get really sticky right around 3%. And it's really forcing this debate. There's a lot of people that are saying, again, the Fed's stated policy target is inflation at 2%. And they say we will have restrictive policy until inflation is at 2%. So you have to kind of ask yourself, if you're Jerome Powell, do you stick to that 2% goal and do whatever it takes to get inflation back to 2%? Or do you just say, you know what, 3 is good enough? We'll just call it good at 3 and we'll say we're happy where we are. But this is this ongoing debate right now in the Fed and in markets. When we look at core inflation, so core is stripping out food and fuel, you see that the core inflation is actually above the headline inflation, coming in at around 4% for the US. Our region is actually doing a little bit better than the nation. We've dropped below that core inflation. Energy prices are actually one of the really good stories of 2023. We thought the energy prices could spike up to $100 a barrel for oil, but we didn't see that. Even with the war in the Middle East, we didn't see a spike in oil. Even with international conflicts, we didn't see that. Even with the shutdown of the Red Sea recently, we saw oil prices actually go down. A big reason for that, though, is weakness in other parts of the world. The Chinese economy is very weak. The European economy is weak. And so we're seeing reduced demand in other parts of the world. And then you have US energy production has been doing really well. And so it's been supporting lower prices in energy. However, I mentioned the housing, that housing inflation. This is another one of those data points that you have to be a little careful about because this is implied housing inflation. And it's also lagged. And so, but that housing inflation is coming in hotter than the Fed would like to see. And we'd like to see, again, the goal. And if you look back before the inflation started, the goal is to get it back to where it was, which is around 2 to 3%. This is the one that I'm really watching. So if you think about the impacts of the pandemic, it really hit supply chains. It really hit consumer demand. We didn't have the ability to go out and go on vacation or go to the movies or do the things that we were doing before. So what did? We bought toilet paper. right? You know, we just started buying stuff. We're just going on Amazon, going crazy. So that, and then you couple that with a breakdown in the supply chain, and that caused that inflation to really take off. But as those supply chains have fixed, as those costs of goods have come down, it's brought down that overall inflation. But if you think about an economy, we've got goods and services. Goods are doing better, but services are way too high. And services inflation is driven almost entirely by wage inflation. So we've got wage inflation that's too high, and we've got the service sector that has inflation too high. This is traditionally the hardest area of inflation to get back to normal. We've seen that in past economic cycles, and so the Fed is going to again. You know, you have to put yourself in Jerome Powell's feet and say, okay, how hard do we go to get the service sector inflation back down to 2% like it was before? One of the big struggles is this infusion of extra cash that we all received during the pandemic. Ultimately, the economy can't return back to normal until all that cash is gone. And there's no way to directly measure how much of that cash is left. But I estimate there's probably another $1 trillion out there of excess savings that people haven't spent yet. And that could take another 6 to 9 months before people actually spend that all down. Now, I know what you're thinking. You're all looking at me saying, I don't know what you're talking about. That money's already gone. And it may be gone for you, but it's not gone for everyone. Especially middle, upper middle class and high income individuals still have a lot of this extra cash and are still spending it. However, if you look at another indicator, and this is showing how it's going to be a little bit difficult. So this is looking at the delinquency rate on consumer loans. If you look at the far right, you'll see that that is moving up very dramatically. So as people are running out of that extra money, what they're doing is they're turning to consumer debt. And we're seeing that level of consumer debt moving up. We're seeing that delinquency moving up. It's not to the level that I'm very concerned about yet, because if you look at it, we've essentially just returned to where we were pre-pandemic, and we're nowhere near where we were in 2008 and 2009. But it's another one of those indicators that I'm going to be watching really closely as that level of debt moves up in the population. One item of warning. Jerome Powell said, we will not repeat the mistakes of the 1970s. And so this great economist took the inflation from the 1970s, that's in blue, and he superimposed our current inflation in yellow. Well, guess what? We are repeating the 1970s. And yes, we're on that down path. But if the Fed doesn't get control of this inflation, if they actually do settle at 3%, that 3% could turn back into 9% overnight. So the Fed does have to get control of this. They have to get this inflation back under control to get the economy back to normal. Let me just close out a little bit with some of our regional indicators that we're seeing. We continue to see these big distortions in population. So this is the brand new data, just came out from the Census Bureau a couple weeks ago. We continue to see people moving out of California, Oregon, Hawaii, Louisiana. Look at New York, big population loss. Where are they moving? They're moving to Utah and Idaho. Also moving to Texas, Florida, and the South. So this is a trend that we started seeing with the beginning of the pandemic, and we continue to see it now. It's not as bad as it was last year, in 2022, but we continue to see those population changes. One of the big benefits, this is a new ranking that came out of US News and World Report, ranked Utah as the best state in America. Number one for fiscal stability. Thank you, Sophia DeCaro. Where is she? There you are. Thank you, Sophia. Number one state for fiscal stability. Number one state for the economy. They also ranked us top 10 in healthcare, in education, and in transportation. So Utah is doing really well. Idaho is doing really well relative to the rest of the country and relative to the rest of the world. When you look at it in terms of population growth, or sorry, employment growth, this is saying how many jobs, what's the change in jobs since the beginning of the pandemic. So we're looking at February of 2020 to our most current data. Number one in the country, Idaho at 11.5%. Number two in the country, Utah, 10%. And then if you compare it to some other states, look at New York, still negative. Vermont, still negative. West Virginia, still negative. Look at Hawaii. Hawaii is down 4.6% compared to pre-pandemic. So you really see kind of the winners and losers and the economies, the markets that are doing really well. And we see that the Intermountain West continues to be doing really, really well compared to other states. Our unemployment rates, so this, again, I mentioned you want unemployment low, just not too low. And that's what we're seeing. Our unemployment in our region is not as low as the Midwest, but is lower than many other parts of the country. Our unemployment rate, when you look at it historically, we're still at relatively low rates. We have seen a little movement up in the unemployment rate just in the last few months, but it's not to a level that I'm concerned about, but it's something that we're watching if we continue to see that unemployment rate moving up in Utah and Idaho. And then this is a really interesting one. We're seeing a divergence in labor force participation compared to Utah and Idaho, where you see that, again, the nation is in blue, Utah's in red, and Idaho's in green. We all saw a hit from the pandemic, but Utah's was relatively mild. And look at that, we've added back a lot of labor participation since then. Utah has seen a surge in labor participation. Idaho, on the other hand, has actually seen their labor participation dropping and is now below the national average. So very different circumstances in the percent of people that are in the labor force in those two states. One of the big struggles that we are seeing, though, and this is true of both Utah and Idaho, this is great research that the Gardner Institute at the University of Utah did. So our average ratio of home prices to household incomes should be about 3. So your home price should be about 3 times your household income. And you can see that it's been around 3. Look at the housing bubble of 2006, got all the way up to 3.7, and then it dropped back down. Where is it today? 6.2. What this is saying is housing is too unaffordable in Utah. Housing is very difficult, especially for low income, especially for young families, people trying to get in. And how do you fix that? You know, that you essentially need to dramatically drop house prices. You need to dramatically increase income, or you need to start thinking outside the box of what housing looks like. What we're going to see is more multi-generational households, more multi-family households, and we're going to have to start talking very seriously about thinking of different ways of what housing looks like in our communities. So kind of bringing it all together, in 2024, I expect that the Fed will follow through and start cutting rates. The only question is whether they go with the 3 that they're predicting or whether they go with the 6 that the markets are predicting. Inflation will continue to slow, but there are those sectors that are going to be tough. It's going to be that service sector, I think specifically, will be one of the tougher areas for them to get back down. The labor market continues to slow. We are seeing, and we want to see that. We want to see that coming off some of that heat. What I don't want to see, though, is that unemployment rate starting to spike up too much. The economy continues to be very resilient. There is the possibility that we could enter a recession in the second or third quarters of this year, but I think if we do, it'll be a relatively mild recession, and we'll move through it pretty quickly. The big question, though, is that kind of these black swans, these shocks to the system, and in a situation where we are, it has been defined by volatility. Any of those shocks could have big impacts. And so those are a lot of the things that we're watching right now. So thanks again for coming, and I'm open to any questions, Rob.
There we go. We only have like 3 or 4 minutes, so I'm just going to ask you a couple, and we'll try to rapid fire this. And just so that you'll all know, those of you who are here, as well as those who are listening online, we will be emailing out a recording of this presentation, so you'll have the opportunity to review what Robert has shared. You'll be able to see his slides again and refer back to them. We also post this video and other economic reports and updates at zionsbank.com/economics, and we encourage you to visit there often to get additional updates from Robert. But so, Robert, you sort of artfully dodged this, as every good economist would. You sort of mentioned it right here at the end, but what is the likelihood of a recession in 2024 and nationally, but then also that impacting Utah and Idaho? Do we go into recession here?
Yeah, and I'll tell you that has been the thing that has gotten a lot of economists scratching their heads, because we all thought it was going to happen in 2023 and it didn't happen. I still think there's about a 50% chance. A few months ago, 6 months ago, I was at closer to 65, 70%. So I do think that probability of recession has gone down, but there still are some of those factors that could tip us into a recession nationally. I think locally, we are part of the national economy, and so we are exposed to that risk, but I think we're well positioned. And if we do go into recession, I think we're in a good position.
Right. One of the questions that had come in, you talked a lot about the changes in interest rates and where we think those might go. Help us understand the lag effect of these changing interest rates. I know there's certainly whether it's a 6 or a 12-month, what does that lag effect look like? How does that impact?
Yeah, and I'll tell you, that's a great question, because that's one of the big struggles. So specifically what they say is Fed policy action has a long and variable lag. And that's essentially us just saying we don't know what it does. But it does. So when the Fed raises or lowers interest rates, it takes time for that to work into the system. So we're living in an environment the Fed created a year ago. And so that's the long part. And then the variable part is what we saw this year, which is we don't entirely understand how markets will respond, how all of you will respond. And so that is what we're kind of experiencing right now. That's why the Fed meets often. That's why they're always coming up with new analysis. This is why I watch these jobs report and inflation reports and the consumer confidence so closely, because we're always trying to understand what's actually happening a little bit better. But that is a really important point, is the Fed stopped raising rates about 6 months ago. And they're going to start dropping those rates, I would guess, in about 3 or 4 months. And so, right now we're kind of living in that higher rate environment, and we're anticipating a lower rate environment, but we'll have to see whether the Fed can actually do that.
Right. And then last question. It's an election year. So what impact is the fact that it's an election year have on the economy this year? And then what's the impact, depending on who's in the White House at the end of the election?
Yeah, and I think that is going to be one of the biggest impacts on the economy. It was does anyone remember James Carville? He was worked for Bill Clinton. He's the person that said it's the economy, stupid. And it's true that presidents don't have a huge impact on the economy, but they definitely get blamed for the economy. And the economy, what you'll see is you're going to see this battle between the White House or Democrats and the White House against Republicans and Congress. Trying to say, well, the economy's doing great, so you should reelect the president, or the economy's doing horrible and you should kick out the bums. And I think that's going to, we'll see signs of that with the debate over the budget, debate over the debt, debate over financial support for Ukraine and Israel. All these are going to come up. And then, if we start to see weakness in the economy, it'll be part of that debate of how aggressively should the federal government step in to provide support. So I think it will dominate a lot of that. It'll be kind of this overarching political environment that we're going to be dealing with in 2024.
Awesome. Robert, thank you so much. We appreciate your insight. And thank you again to all of you for joining us. We also thank all of you for choosing to do business with Zions Bank. We appreciate your business. As you all hopefully know, last year we celebrated our 150th anniversary. And now as we enter our next 150 years, our commitment to you and to our communities is stronger than ever. So thank you for being with us today. Thank you for your business, and thank you for all that you do. Robert will be around if you have specific individual questions you'd like to ask to Robert. He'll be here for several minutes. So please come up and feel free to ask him. But thank you so much, and enjoy the rest of your day.